Bill Lee is here now. He's the chief economist at the Milken Institute. He is also a member of the Power Lunch mock Fed, and he voted for a cut like this. Bill, welcome. And, markets, they're kind of reacting to this by saying, well, wait a minute, just what is inflation going to look like next year for this economy, and how many more cuts will there be, really?
Well, Kelly, I think the markets are really reacting to the fact that we have a lot of strong tailwinds in back of us, strong GDP growth, but most importantly, inflation really has not come down in the places where it's supposed to come down most of all, which is the domestic services area. Even ex-housing, we've seen PCE core inflation rise at about a 3.5% pace, and it really hasn't changed since the beginning of the year. And what we have to remember is that the markets, not so much the Fed, are in control of that long end. And so when we talk about how are rates doing, are they going up or down, we have to ask which rates. And yes, you're right. All these strong tailwinds are helping to raise long rates, but the short end is still very tight. We had heard this morning from Brian Moynihan of Bank of America that banks are having an incredibly hard time making loans to small businesses at rates that they can actually use.
Oh, sure.
And so we have tightness at the short end and easing of financial conditions on the long end. And so the bond market is really reacting to the fact that the long end, which is what they control, has to get tighter. But the Fed is very convinced that we need to help banks make loans to the businesses that really need them, which are the debt financing business like small businesses.
So we can kind of talk about the neutral rate as it relates to all of this. The Fed said the sort of average or neutral rate has risen to 3 from 2.9%, just to correct our banner, what Steve had said, to 3% from 2.9%, which might not sound like a big deal, but you get a 3 handle. And what does that tell you?
It's telling me that the productivity growth that we've seen and the strong growth that we've seen may actually be sustainable, which means that in the long run, the neutral rate has to be higher, not just because of inflation, but because of real productivity. And that's a good thing. And that's going to help us have higher wages and lower inflation in the future. But right now, I think the key is we're so far above that neutral rate at the short end, the Fed really has to do its adjustments and lower that short rate down to more reasonable handle, a three handle or better. And so I think what the FOMC discussion is about is how fast do we do this? How fast do we bring down the short end without frightening the markets in a way that makes them think that, my God, we're going to be boosting inflation even further from where it is?
I'm curious, Bill, you and a lot of others similarly situated as you as an economist and a thought leader here say that we have a strong economy and tailwinds at our back. And yet the Fed seems to be reducing the GDP growth forecast from 2.5% this year to 2.1 next year to 2.0 in 26. Those feel like fading tailwinds, if you will.
Well, it's a composition of that fade that you need to worry about, and that's what the Fed is worried about. We have the strong tailwinds right now because consumer is very strong, but much of that consumption is based upon 20% of the population that owns 75% of stock market wealth. And those people are spending like crazy. They're going on business class vacations, but the 60-70% of the population that voted for President Trump saying we can't make ends meet, those are the people that are having trouble, and if their consumption is not growing as fast. And what the Fed is recognizing is that we cannot sustain the kind of strong consumption and strong GDP growth that we've seen now and probably into early next year into the future. And that's why their GDP forecast is being reduced in recognition of the fact that a lot of the consumption that we see now is going to be coming down. But nevertheless, the strong tailwinds are still there boosting inflation because the rigidities that hold up inflation are still there. So in some ways, the bond market says we need higher rates because inflation isn't coming down. The Fed is saying right now we need to anticipate the fact that the growth will start to disappear as soon as consumption starts to cool down.